I want you to picture something for a moment. Not a hypothetical, not a textbook example. A real living room in a real house somewhere in suburban Phoenix, Arizona. The man sitting at the kitchen table is named Raymond. He is 73 years old. He has a cup of coffee that went cold 20 minutes ago because he has been staring at a letter from his wife's neurologist and he cannot make himself put it down. Raymond's wife, Carol, is 71. They have been married for 48 years. Carol was a school librarian for 26 years. Raymond spent his career as a civil engineer for the county. They did everything right. They paid off their house in 2018. They have a traditional IRA worth $380,000. They have about $90,000 spread across a savings account and some CDs at their local credit union. They never carried debt they could not manage. They took care of each other. And now Raymond is sitting at that kitchen table, holding a letter that uses words like progressive and placement and memory care, and he is doing math in his head that he was never taught how to do. He is trying to figure out how much of what they built together is going to survive what is coming. And the answer, if Raymond does nothing between today and the day Carol walks into a memory care facility, is almost none of it. The house will go to the state through estate recovery. The IRA will be spent down to near zero paying for care before Medicaid steps in. The savings will be gone inside of 8 months at current memory care rates. And Raymond, the man who spent 40 years engineering things to last, will be left living on Social Security and a partial pension with nothing to pass to his kids and nothing to show for a lifetime of doing the right thing. That is not a worst-case scenario. That is the default outcome. That is what happens to the American middle class when nobody tells them how this system actually works before the crisis lands on their kitchen table. I am going to tell you right now, this is Retire Right America, and the next 30 minutes might be the most important financial education you have ever received. Before I give you the 3 assets and what you need to do with them, I need you to understand the machine you are dealing with. Because if you walk into this without understanding how Medicaid long-term care actually functions, the strategies are going to sound like tricks. They are not tricks. They are the logical response to a system with specific rules, specific timelines, and specific exemptions that the government built into the law and that most families never find out about until it is too late to use them. Medicare does not cover nursing home care. I need you to hear that sentence again, because half the people watching this video believe that Medicare will take care of them if they ever need a nursing home. Medicare covers short-term skilled nursing care after a qualifying hospital stay, up to 100 days under very specific conditions, and then it stops. After Medicare stops, you pay privately. Private pay rates at memory care and skilled nursing facilities in 2026 average between $9,000 and $13,000 per month, depending on your state and the level of care required. You burn through savings at that rate incredibly fast. When your savings are gone, when your assets are below the applicable threshold, you apply for Medicaid. Medicaid is the government program that actually pays for long-term nursing home care. But to qualify, you have to be nearly broke by design. The applicant's spouse, the one in the facility, is generally allowed to keep about $2,000 in countable assets. $2,000 after 40 years of saving. The state looks at your bank accounts, your brokerage accounts, your CDs, your traditional IRA in many states, the cash value of your life insurance, and ultimately your house through a mechanism called estate recovery. And there is one more piece of this machine that makes the whole thing feel like a trap, specifically designed for people who planned carefully. It is called the 5-year lookback period. Any transfer of assets for less than fair market value that happened within 60 months of the Medicaid application gets penalized. The state goes back 5 years and examines every financial move you made. If they find transfers to your children, to a trust, to anyone, that were not for fair market value, they calculate a penalty period during which Medicaid will not pay. You cannot simply give your house to your kids the week before the nursing home application. You cannot wire your savings to your daughter 2 months before Carol needs placement. The state will find it. The caseworker will calculate the penalty. And that penalty period, during which you are expected to pay privately, will hit at the exact moment when you have no liquid assets left to pay with. This is the machine. Now let me show you the 3 assets it is targeting and what you have to do before it gets there. The first asset is the family home. Raymond and Carol's house in Phoenix is worth $310,000. It is paid off. And Raymond, like most homeowners his age, looks at that house as his foundation, his security, the thing he can always fall back on. Here is the reality that nobody is going to tell Raymond at the Medicaid office. While Carol is in memory care and Raymond is still living in the house, The house is exempt from Medicaid's asset calculation. Federal law protects the primary residence when the community spouse, meaning the spouse who is not in the facility, is still living there. So Carol can qualify for Medicaid without the state forcing Raymond to sell the house while he is alive. Raymond exhales when he hears this. Raymond thinks the house is safe. Raymond is wrong about the timeline. Because the exemption is not permanent, it is conditional. The moment Raymond dies, the condition disappears, and the state of Arizona, through its Medicaid estate recovery program, files a claim against Raymond's estate for every dollar it spent on Carol's care. If Carol spent 3 years in memory care at $11,000 a month, the state paid $396,000. The house is worth $310,000. The state takes the house. Raymond's children inherit nothing from the asset their parents spent decades protecting. Federal law requires every state to have an estate recovery program. This is not a policy choice your state made. It is a federal mandate. The state is legally required to pursue recovery. What varies by state is the aggressiveness of the recovery, whether it extends beyond probate assets, and what exemptions are available to the heirs. But the mechanism is universal. The paid-off house is not protected. It is deferred. The state is patiently waiting for the surviving spouse to die. So what does Raymond do? If Raymond still has more than 5 years before Carol is likely to need Medicaid, the most powerful tool available is the irrevocable Medicaid Asset Protection Trust, which estate planning attorneys commonly call a MAPT. Raymond transfers the house into this trust. He retains the right to live in the house for the rest of his life. He retains any income the house generates. What he gives up is the ability to sell the house and personally pocket the proceeds, though the trust can sell and purchase a replacement home in many structures. After 5 years from the date of transfer, the house is outside the Medicaid lookback window. The state cannot recover it. When Raymond and Carol pass away, the house transfers to their children outside of probate, outside of estate recovery, with a potential step-up in cost basis under Internal Revenue Code Section 1014, meaning the children may be able to sell a $310,000 house and pay zero capital gains tax on the appreciation that accumulated over Raymond's entire ownership period. The irrevocable trust accomplishes 3 things simultaneously. It removes the house from Medicaid's reach after 5 years. It eliminates the probate process, and it preserves a potential step-up in basis that saves the next generation from a significant capital gains tax bill. If Raymond has less than 5 years, the options change but do not disappear. In states that recognize it, which currently includes Florida, Texas, Michigan, Vermont, and West Virginia, the enhanced life estate deed, commonly called a ladybird deed, allows Raymond to transfer the house to his children while retaining complete control during his lifetime, including the ability to sell, mortgage, or revoke the transfer entirely. In most states that recognize it, this transfer does not trigger the Medicaid lookback. In states that do not recognize ladybird deeds, a spousal transfer or other Medicaid crisis planning tools may be available depending on specific circumstances. The right tool depends entirely on your state and your timeline, but the principle is the same everywhere. The house must be repositioned before the Medicaid application, not after. After is too late. The second asset is the traditional IRA or 401k. This is the one that catches people completely off guard because retirement accounts feel protected. They feel like they exist in a different legal universe from ordinary bank accounts. And for purposes of bankruptcy protection and certain creditor claims, they often do. But Medicaid is not a creditor in the ordinary sense. Medicaid is a means-tested benefit program administered by the states, and the states have significant latitude in how they classify retirement accounts for eligibility purposes. In many states, once the account owner has passed the age at which required minimum distributions must begin, currently age 73 under federal law, the traditional IRA is considered a countable asset for Medicaid purposes. The state's reasoning is straightforward. You are required by law to take distributions from this account. Therefore, it is accessible to you. Therefore, it is a resource. Therefore, we count it. Raymond's IRA is $480,000 and he is 73. In Arizona and many other states, that IRA is potentially fully exposed as a countable asset in Carol's Medicaid analysis, depending on how the state treats the community spouse's retirement account. Some states fully protect the community spouse's IRA. Others count it toward the community spouse resource allowance. You need to know your specific state's rules because the difference can be enormous. But regardless of your state's specific treatment of the community spouse's IRA, every dollar sitting in a traditional pre-tax retirement account carries a tax liability that grows every year. Every dollar Raymond eventually pulls out of that IRA comes out as ordinary income, taxed at whatever his marginal rate is at the time, subject to IRMA surcharges on his Medicare premiums, subject to the Social Security taxation calculation, and after Carol dies, hitting him at the higher single filer rates with no married filing jointly protection. The IRA is not just a Medicaid problem. It is a tax problem that compounds every year Raymond waits. The solution, and I want to be very clear that this is a solution that must be executed while both spouses are alive and relatively healthy, is a phased Roth conversion strategy. While Raymond and Carol are filing married jointly, they can fill the 22% federal bracket with Roth conversion income. For a married filing jointly couple in 2026, the 22% bracket extends to a significant level of taxable income, giving Raymond a wide runway to convert traditional IRA dollars to Roth dollars at a controlled rate. Every dollar that goes through that conversion gets taxed once at the current rate, and then grows permanently tax-free, with no required minimum distributions during Raymond's lifetime, and no income tax on withdrawals for either Raymond or his heirs. A Roth IRA does not generate taxable income when you withdraw from it. That means no additional Social Security taxation from Roth withdrawals. No IRMA surcharges triggered by Roth withdrawals. And in some states, a legitimate argument can be made that a Roth IRA with no required minimum distributions is not an immediately accessible resource for Medicaid purposes in the same way a traditional IRA subject to mandatory distributions is. I am not promising you that Roth conversion is a Medicaid shield in every state. The law varies, and it is evolving. But combining the tax benefits with the potential Medicaid positioning advantages makes controlled Roth conversion one of the most powerful pre-planning moves available to a couple in Raymond and Carol's situation. Every year Raymond delays this conversion is a year that money sits in the worst possible structure, fully taxable on the way out, potentially countable for Medicaid, and guaranteed to hit his surviving spouse at single filer rates after Carol passes. The conversion is not painless. Raymond will pay tax on every dollar converted, but he will pay that tax at the married filing jointly rate in a controlled amount in the widest possible bracket. The alternative is paying tax on forced distributions at the single filer rate at an uncontrolled amount after Carol is gone and Raymond has no planning flexibility left. Now let us talk about the third asset, the savings account, the CDs, the taxable brokerage account. This is the most transparent category for Medicaid purposes because there is no ambiguity. Cash is countable, CDs are countable, brokerage accounts are countable. Everything above the applicable limits has to be spent down before Medicaid will engage. For the applicant spouse, the limit is generally $2,000. For the community spouse, federal law provides a protection called the Community Spouse Resource Allowance, which in most states in 2026 allows the community spouse to retain approximately $150,000 in countable assets. Raymond and Carol have $90,000 in savings and CDs. That entire amount is below the Community Spouse Resource Allowance, which means Raymond can keep all of it and Carol can still qualify for Medicaid from a resource standpoint, assuming the IRA and the house are handled correctly. But many families are not in Raymond's position with savings. Many families have $200,000, $250,000, $300,000 sitting in joint savings and brokerage accounts. The amount above the Community Spouse Resource Allowance is exposed. The state expects it to be spent on the nursing home before Medicaid kicks in. And the families who do not know about the tools available to them will simply write checks to the nursing home every month until that money is gone. There are legal strategies for repositioning assets above the Community Spouse Resource Allowance that do not involve transferring money to children and falling into the lookback window. A Medicaid-compliant annuity is one of the most powerful. The community spouse can take excess countable assets and purchase an irrevocable immediate annuity that pays a monthly income stream for their actuarial life expectancy. This converts a countable lump sum into an exempt income stream. The excess asset disappears from the countable asset calculation. The community spouse receives monthly income for the rest of their life. The applicant spouse qualifies for Medicaid more quickly. The annuity must be structured precisely according to each state's Medicaid requirements. It must be irrevocable, non-assignable, and actuarially sound. It must name the state as remainder beneficiary up to the amount Medicaid paid after the community spouse dies. These are not products you buy at a bank. These are specialized Medicaid planning instruments that must be structured by an elder law attorney who does this work daily. Done correctly, they are among the most effective tools for accelerating Medicaid eligibility without losing assets to the nursing home spin-down. Done incorrectly, the state treats the purchase as a disqualifying transfer, and the family ends up worse off than before. There are also permitted expenditures that can legitimately reduce countable assets without triggering the lookback. Paying off the mortgage on the primary residence converts cash into equity in an exempt asset. Making necessary home improvements, accessibility modifications, roof work, HVAC replacement, bathroom updates, converts countable cash into improvements to an exempt asset. Purchasing one exempt vehicle or upgrading the existing one. Prepaying funeral and burial expenses through an irrevocable funeral trust up to your state's permitted limit. These are not tricks. These are explicitly permitted uses of countable assets that the Medicaid system recognizes as valid. They reduce the countable number without creating a transfer that the lookback period can penalize. A competent elder law attorney will help you identify which specific expenditures are permitted in your state and how to document them properly so they are not challenged during the eligibility review. I want to come back to Raymond one more time, because I started this video with Raymond sitting at a kitchen table holding a letter he could not put down, and I want to end it with a different version of Raymond. A Raymond who found Retire Right America before the placement happened. A Raymond who called an elder law attorney 6 months after watching this video, while Carol's condition was progressing, but before it reached the point where a facility was unavoidable. That Raymond transferred the house into a Medicaid asset protection trust within 60 days of his first attorney consultation. He retained the right to live there for the rest of his life. His children are named as the beneficiaries. After 5 years, the house is outside the look-back window entirely. That Raymond began converting his traditional IRA to Roth at a controlled rate of $70,000 per year, staying inside the 22% bracket, reducing the traditional balance systematically while both of them were filing married jointly and the bracket was at its widest. That Raymond worked with his elder law attorney to document his home improvements and vehicle purchase as permitted countable asset reductions, bringing his remaining cash savings within the community spouse resource allowance without triggering any look-back issues. When Carol's Medicaid application was filed, the house was in the trust and exempt. The traditional IRA had been substantially converted to Roth, and what remained was being analyzed under Arizona's specific community spouse rules. The countable savings were within the protected allowance. Carol qualified for Medicaid coverage of her memory care. Raymond kept the house. Raymond kept his pension and his Social Security. Raymond kept the Roth account growing tax-free, with no required minimum distributions threatening to push him into a higher bracket every year. His children will inherit the house with a step-up in basis and the Roth account with no income tax due. Raymond did not find a loophole. Raymond did not do anything illegal or even aggressive. Raymond used the legal tools that the Medicaid system itself provides, in the right order, at the right time, with the right professional guidance. That is what Retire Right America exists to show you. If you are watching this video right now, go to the comment section and tell me 4 things. Tell me your state. Tell me your approximate age. Tell me whether you own a home free and clear or with a mortgage. And tell me whether your primary retirement savings are in a traditional pre-tax account or a Roth. From those 4 data points, I can tell you in a reply whether you are in a high-risk state for aggressive estate recovery, whether your IRA is likely to be treated as a countable asset under your state's Medicaid rules, and what your single most urgent first move should be. I read every comment on this channel. Retire Right America is built on the belief that the families who ask specific questions and get specific answers are the ones who end up with plans instead of crises. Drop your field report in the comments. We analyze it together. The window you have right now, if you and your spouse are both healthy, is the most valuable financial asset you own. The 5-year look-back clock has not started. The house can be repositioned today. The Roth conversions can begin today. The elder law attorney consultation can happen this week. Every month you wait is a month the window gets smaller. Every diagnosis that arrives before the planning is done is a door that closes on one of these tools. The system is designed with the assumption that most families will wait. The state benefits from that assumption. The nursing home spin down that happens because a family did not know about the community spouse resource allowance, did not know about Medicaid compliant annuities, did not know about the irrevocable trust, did not know about permitted asset conversions, that spin down is money the state does not have to pay. The financial incentive of the Medicaid system is built on your inaction. Retire Right America exists to make you an exception to that assumption. Like this video if it changed the way you think about your house, your IRA, and your savings in the context of long-term care. Subscribe and hit the notification bell so the next survival manual reaches you before the relevant letter does. Share this with one married couple you care about. One conversation today between 2 people who are still both healthy can preserve a lifetime of work that the default system is designed to consume. The tools are in the law. The escape hatches exist. You just have to move before the state does.